everyone, this is Demel Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest market update and outlook video. This month's video is mission accomplished. I don't know if you recognize this picture. This is the banner that we put up during the Iraq War when we thought we had won the war and it wasn't quite done yet. And it ended up being kind of an embarrassing banner. And so I'm alluding to, maybe is the Fed done? Can they say mission accomplished? So we're going to get into that. We're going to talk about what's going on in the markets and always get into the outlook and some of the shifting that's happening for 2024. So let's get started. All right, so here are the asset class returns for the month of November. The blue, as you can see, is the month of November. The green is the year to date. Now, this is much better, right? So large cap was up really nicely, up 9% for the month. Small caps up 8.25%. Look at real estate. That's a great year all in 1 month. So if you didn't have any access to real estate because you were nervous about the real estate market, you missed a tremendous month or almost a whole year of returns in this 1 month. International started to come back as well. So you can see international actually did a little bit better than the U.S. domestic stocks. And even emerging markets did pretty well. Basically all the returns of the year for emerging markets were gained last month. U.S. fixed income was actually in the hole as of last month, and it was up nicely, up 4.4%. We're going to talk a little bit more about that in the market update. High yield was also up nicely, and commodities were actually down. So that's part of the story. Inflation has been coming down. We're going to talk more about that as well in the update. But that's why you're seeing the market having a nice little rally as we're starting to anticipate the fact that the Fed is probably done with raising rates. All right, I alluded to it in the asset class returns. We have the CPI report and also the PCE report that came out later in the month of November, came up as showing inflation was pretty benign for the month of November, which then brings the year over year numbers down a little bit as well. So you can see 0% month over month, 3.2% year over year. That's starting to feel a lot better. Now, the Fed's goal is still to get it to 2%, so we're not quite there. And a lot of the heavy lifting, if you remember my analogy about doing push-ups, it's those last few push-ups that are the hardest. So we still got a good ways to go, and it's going to be hard to get that last few push-ups done, but we're definitely more in a lower and more tolerable inflation rate. The other thing that I would point out is the red line here, which is core inflation. Core inflation is actually still a little higher than the regular, what they call headline inflation, but you can see it's coming down as well. And this one has historically always lagged because it has shelter, and we've talked about many times in many of my other videos about how shelter has a lag of about 9 to 12 months. So it will probably continue to go down even when the headline inflation number maybe plateaus. So you saw the inflation numbers look a lot better for the month of November and on a good trajectory. So when the Fed saw this, they paused again, and they didn't speak as harshly as far as what they're going to do going forward with the Fed rate hikes. It looks like the pause is going to continue for a while, and the market kind of read between the lines as they're probably done, although they will never say that until it's completely obvious to everybody. But here's what happened to the bond market over the last month. We hit 5% on the 10-year U.S. Treasury bond, and as of a couple days ago, we actually got into the 4.2 and a little bit below range. This is a massive move in the 10-year Treasury. It usually moves like 0.1% over months, not not over a 0.5% in a month. So this was a giant move. This is why you saw the market do well. This is why you saw the bond market do well. In fact, this was the best month that the bond market has had since the 80s. So it was a big comeback in the bond market. For those folks that were sitting in cash and were way underexposed to bonds, you really missed out on pretty much a whole year's worth of returns in one day. And so this is why it's so hard to time the market. Things can change on a dime. We were very pessimistic just a month and a half ago in the middle of October, and things really changed around after that CPI number came out, and more Goldilocks economic figures that we will talk a little bit more about here in just a minute. So here's a pretty good summary of the economic Goldilocks. If you remember from my video last month, I talked about the 3 things that had to happen for the market to continue to rally through the year. And one was we had to get inflation continue to come down. So we've been heading in a good direction there. We had to get the Fed to stop raising rates, at least pause. So that looks like it's also in place. And we had to have economic Goldilocks, where the economy doesn't get too hot because then that's inflation, or too cold because then that's recession. And so far, it does seem like we are threading that needle pretty nicely. You can see these are the ISM numbers for manufacturing. And in October, it was 46.7, which is a contracting number. But then you can see in November, the number was pretty much the same. So it's not like anything is falling off a cliff. It's kind of hanging in there. Manufacturing has been contracting for quite a while now, but it doesn't seem to be accelerating. And on the ISM services, we have the flip side. We have the October number at 51.8, which is growing. Now, not growing a lot, because remember 50 is that benchmark where it's above, it's growing, below, it's contracting. And so it's growing a little bit, and in November it actually accelerated just a little bit more. So it's a sign that, again, the services part of the economy is actually still looking pretty strong and growing. The manufacturing part of the economy is kind of flatline. Of course, the services part of the economy is a bigger part of the economy. It's more important in the United States. So that's why you're seeing overall the economy is still hanging in there. Although, of course, there are a lot of cracks that are forming, but it seems to be hanging in there. And in fact, today we just got the unemployment, the jobs number from the BLS. It shows that we actually still had decent jobs growth for the month of November. It was 199,000, actually a little higher than what was expected at 190, and the unemployment rate kind of ticked down a little bit, which was, again, a little surprising. So the economy continues to hang in there. Will it continue to hang in there? That is the big question. I'm a little skeptical about that, but these numbers certainly gave some optimism, not just to me, but of course to the market. All right, let's get into the market outlook. One of the big themes that I think we're going to see for the year 2024 is a focus fading from everything being about inflation and what the Fed's doing about inflation to what's going on with corporate earnings and the economy. So that's why I wanted to introduce to you this chart that shows in the dark blue bars the actual earnings for the S&P 500. And in the light colors here, you could see these are the estimates for 2023 and 2024. Now, 2023 is practically over, and that number is actually pretty much an actual. And you can see for 2023, there really wasn't much earnings growth. I mean, it was tiny. It's like 1% earnings growth. Part of the reason why you probably saw the economy really not grow that much, although the stock market actually did pretty good, ironically, and that's because inflation was coming down. Now, next year, inflation's probably not going to come down as much. It's going to kind of stay low and hopefully work a little bit lower, but a lot slower. So it's not going to be so much about inflation. I think it's going to be more about the earnings. And as you can see here, the estimates the analysts have for earnings is a pretty decent growth here. That is about a 10-11% earnings growth. So if we can get 10 to 11% earnings growth, that would mean that we would probably avoid a recession and the stock market could do pretty well. Now, I'm a little skeptical that can happen because it does seem like things are getting a little bit worse with credit. And there's a lot of other leading indicators that are showing some cracks that are forming. But this is definitely a good sign that analysts feel that corporate earnings are going to hold up and still grow for 2024. All right, the last thing I want to talk about for the outlook before we talk about the implications are the question that is basically the million-dollar question here is, are we going to have a soft landing where there's really no recession at all or barely a recession? Or are we going to get more of a hard landing? And I wanted to show you this chart. This is actually pretty cool. It shows how when the Fed raises interest rates, how there's usually a recession, okay, shortly after that. So in other words, the Fed does not have a very good track record of raising interest rates to slow down inflation and avoiding a recession. You can see the dark gray lines here are a recession. So the pattern is there. Fed raises rates, and recession. Fed raises rates, inflation, or recession. Fed raises rates, and recession again. And here we are in 2023. Are we going to have a recession? Now, there was one time in the last 50 years or so when the Fed raised rates and didn't have a recession. It was right around 1994 and 1995. So this is the anomaly. Now, this is kind of the consensus at the moment that the Fed is going to be able to engineer this soft landing. And I'm a little skeptical of it because you can see the track record is not very good. And I would also add that during 1994-95, I looked it up. The inflation never really got that high, so they didn't really have to raise rates that much. And as you can see here, this is what's been happening here recently in 2022 and 2023. Inflation got all the way up to 9%, and we've had to raise rates a lot more. So the more they raise rates, you can see the higher the probabilities of the recessions, okay? And over here. And so I'm not feeling super confident that we're going to be able to avoid the recession like the market is hoping for. But maybe it won't be as bad as some of these others, and it will be a very light recession. And the reason that's important is because usually the stock market doesn't bottom before a recession. It usually bottoms during or shortly after a recession. So there could be a little correction depending on how bad that recession is. And so you can see I'm still a little skeptical, which makes me be a little less bullish and a little bit more cautious, which leads us right into the implications. All right, here we go. Heartwood implications. It's yellow. That means slow. All right. So we're still neutral, kind of cautious with our portfolios. The one thing that I am starting to do, especially with my more aggressive clients, I'm starting to nibble and incrementally adding a little bit more to small caps and international. But for the most part, keeping that neutral weighting to stocks, trying to continue to add a little bit more duration or a little longer maturities to the bonds. Again, pulling that in from cash and any rebalancing that we're going through in a portfolio on a regular basis. So still playing it kind of safe, but starting, again, nibbling in there with the more aggressive clients. And if we see that the inflation continues to go down and the Goldilocks economy continues to hang in there, I will get a little bit more incrementally into those small caps and international, and maybe even start to add more to stocks as a percentage of the portfolio. But I'm not quite there yet. I wish I had more conviction about this, but the history, as you saw there, it shows that it's just really tough for the Fed to pull this off perfectly. All right. I hope this helps, guys. Thank you for watching. I hope everybody has a wonderful holiday season. And please feel free to share the video with friends and family. And as always, thank you and God bless.